You had a good year, revenue was up. You landed a few big contracts and the business ran the way it was supposed to run. And then you sat down with your accountant in February and found out you owe the IRS more than you paid for your last truck. That's not bad luck, that's a planning problem. And in this video, I'm going to show you exactly how to fix it, starting with why your business structure may be costing you more in taxes than anything else. And it has nothing to do with write-offs. We'll also cover how to use retirement planning to move money out of the business and into your own pocket tax deferred, and why the way you're paying yourself might be the single most expensive mistake on your tax return right now. If you had a tax bill this year that felt way too high, you're not alone. That's the most common thing I hear from business owners. They had a good year, they had solid revenues, but when they saw that tax bill, it felt like that tax bill swallowed up all the profit. That's usually not a write-off problem. That's a planning problem. And it almost always starts here. First, how is your business actually being taxed? Most business owners I talk with must say something similar to this. Say, yeah, I have an LLC. They say it like it means they have a tax strategy. And it doesn't. Here's the thing. An LLC is a legal structure, not a tax structure. And depending on how the LLC is set up, it could be taxed as a sole proprietor, a partnership, an S Corp, or a C Corp. And the distinction changes everything. It changes how your income is reported, whether self-employment taxes apply, what planning options you have access to, and how much of your profit is actually staying in your pocket. So before you go looking for deductions, and we'll cover those, the first question is this: how is your business actually being taxed? A lot of businesses start out as a simple sole proprietor or single member LLC. That made sense when the business was small and you were getting off your feet. But once profits get consistent, once you're clearing $150K, $200K, or $300K a year in business profit, that default setup may be costing you thousands in taxes you don't legally owe. And here's something I want you to keep in mind as we go through all of this. The structure decision doesn't just affect your taxes today. It affects what you can do with the assets the business already owns. Number 2, your retirement plan. Let me ask you a question and be honest. Do you have a retirement plan set up through your business right now? If the answer is no, or the common, I've been meaning to do that, you're not alone. Let me share with you a story. I had a business owner reach out to me and they were looking and ready to retire. They were both in their mid-60s and ready to vacation and do whatever retired people do. They had been in business for themselves for over 20 years. And with a business revenue in the 7 figures. Guess how much they had saved up for retirement? If your guess was less than $150K, you'd be right. Don't let a profitable business go to waste by not building up a nest egg for yourself. Now, from a tax perspective, a lot of business owners chase deductions. Buy something, write it off, save a little on taxes. But think about what you're actually doing. You're spending $1 to save maybe 30 cents. That's not wealth building. That's just fancy spending. A retirement plan flips that completely. Instead of spending money to get a deduction, you're moving money from your business into your own account, tax deferred. You still get the deduction, but you keep the dollar. It's sitting in an account with your name on it, growing completely separate from the business. And for a business owner, the numbers can be significant. Depending on your business profit, your age, and whether you have employees, a SEP IRA, a 401k, or a cash balance plan could potentially shelter away anywhere from $50,000 to well over $100,000 per year from taxes. That's not a rounding error. That's real money that either goes to the IRS or goes to you. And there's a reason I want you to get this piece right before we talk about the next item, because these two are more connected than most people realize. Number 3 is the QBI deduction, or the qualified business income deduction. This one is the one I see get missed or botched more than almost anything else. And now you're about to understand why I told you to pay attention to the retirement plan piece first. QBI stands for qualified business income. And if you own a pass-through business, a sole proprietor, a partnership, an S Corp, you may have qualified for a deduction of up to 20% of your qualified business income. That's not 20% off your tax rate. That's 20% of your business income that potentially doesn't get taxed at all. Let's put a number on it. If you've got 400 grand in qualified business income and you get the full deduction, That's 80 grand that never hits your taxable income. Depending on your bracket, that could be worth $20,000 to $30,000 in actual tax savings every single year. But here's the catch, and this is exactly why retirement planning matters. The QBI deduction has rules, and one of the things that can quietly reduce or eliminate it is how your retirement contributions are structured. This is one of the first things I look at when I'm working through someone's tax picture, because most of the time, nobody's ever connected these two dots for them. If your accountant has never walked you through how your retirement plan and your QBI deduction interact, that conversation needs to happen before the end of the year. Here's something worth noticing about everything we've covered so far. Structure, retirement, and QBI. None of that requires you to spend a single dollar. No equipment purchase, no new expense, you don't have to hire a new employee, just decisions and proper planning. Decisions and planning that most business owners have never been walked through, because most put their head down and work. They don't step out to work on the business. And if you're watching this and thinking, I've got some of these areas that need a second look, that's exactly the kind of thing that I do and work with through business owners. Going through each of these areas, running the actual numbers for your specific situation, and figuring out where the real opportunities are. Remember back at the beginning when I said the structure decision ties directly into something else? This is it. How you pay yourself out of the business is one of the most consequential and most commonly mishandled parts of the whole tax picture. And almost nobody gets walked through it properly. Here's how it usually goes. A business owner sets up to file as an S Corp. They hear that it saves on self-employment tax and picks a salary number. Sometimes it's what their accountant suggests, sometimes it's what their buddy down the road is paying himself. Sometimes it's just a number that felt reasonable, and then it never gets looked at again. That number matters more than most people realize, and here's why. If your salary is too low, the IRS is going to notice. S Corp owners who work in the business are required to pay themselves reasonable compensation. Too low, and you're looking at audit risk and potential back taxes and penalties. But if your salary is too high, and this happens just as often, you're paying payroll taxes on dollars you don't have to. Social Security and Medicare taxes on income that could have been distributed instead. On a business generating $500,000 in profit, the difference between a poorly structured salary and a well-structured one can easily be $15,000 to $30,000 a year. Every year, just sitting there. This is one of the most common patterns I come across with business owners. The salary number gets picked arbitrarily, and it just never gets revisited. Meanwhile, it's costing them money every single year. Look, we just covered a lot of ground. Structure, retirement plans, QBI, and owner compensation. 4 areas where business owners are quietly overpaying the IRS every single year. And here's the thing. Most of the business owners I talk to aren't overpaying because they're doing something wrong. They're overpaying because they're busy building a business, and nobody has ever sat down with them and gone through this stuff specifically for their situation. They hand over the documents to their accountant in the spring, their accountant files a return, and they hope the number isn't too bad. That's not a plan. That's lighting money on fire. If you're a business owner and you want a way to find out if your taxes are being optimized, I have a business tax efficiency score you can get in less than 90 seconds. You'll see how efficient you are with your taxes and what areas can be improved. Click the link in the description below. And if you're interested in learning more about tax savings like depreciation, business expenses, timing, and some advanced planning after you have a solid foundation, watch this video next.